The stock market has been very volatile lately as a result of growing recession fears, the Japanese carry trade thing, second quarter result announcements, as well as Iran's expected attack on Israel. And this has caused some of my top picks to drop quite a bit in recent weeks, and in today's video I want to provide you an update on some of those and review whether now would be a good time to buy the dip. Hey everyone, this is Yussi. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to discuss some of my top picks that crashed in recent weeks. But before I get into it, I want to let you know that I plan to soon interview the management teams of 5 different REITs, and this includes Whitestone REIT, BSR REIT, Farmland Partners, New Lake Capital Partners, as well as Easterly Government Properties. I will post some of these interviews for free on my new Substack, and if you don't want to miss those, you can subscribe to the Substack for free. I'll put a link to it in the description of this video. So the first company that I'm going to discuss here is called Patria Investments. Its ticker symbol is PAX. For those of you who are not familiar with the company, this is the leading alternative asset manager in Latin America. Many people call it the Blackstone of Latin America because it has a very similar business model. It's the leader in that region, and it used to even closely collaborate with Blackstone back in the days. Blackstone even used to own a stake in Patria. Its main business is to manage private equity, infrastructure, credit, real estate, and even REIT investments for other investors in exchange of fee income. And the investment thesis is pretty simple here. The company has managed to grow its fee-related earnings by over 20% annually since going public, and we think that it can keep this going for a long time to come. But despite that, the company is today priced at just around 7 times its fee-related earnings, adjusted for the unrealized but accurate performance fees which we deduct from its current share price, and that's a roughly 2 to 3 times lower valuation multiples than at what its US peers are trading at. I agree that Blackstone, KKR, Carlyle, Brookfield and so on deserve to trade at a slightly higher multiple than Patria because it's focusing on a riskier region of the world. However, I think that the discount here is really excessive, and especially so when you consider that Patria has almost no debt and it's expected to be debt-free by the end of this year. It's growing at a faster pace than most of the companies that I just listed. It has a stronger moat in its local market, and that market is also less competitive. But even despite all of that, the company just recently got even cheaper. The company announced its second quarter results on the 1st of August, and the share price dropped by 4% on the same day. Then in the following days, the market got concerned about the potential recession, and this caused the entire alternative asset management peer group to drop quite a bit more. Some companies like KKR dropped by over 10% in a single day. As a result, Patria is now about 10% cheaper than when I last discussed it on this YouTube channel, and I think that this is a great buying opportunity because the company actually released some very strong second quarter results. It increased its guidance for the full year 2024, it also hiked its guidance for 2025, then it continued to grow its REIT asset management business, which is very important to me because, you know, Blackstone was extremely rewarding to its shareholders over the past 10 years, in large part because it was able to grow a sizable REIT business. And the REIT asset management business is especially interesting because the capital is permanent, and as a result the fee income is very sticky, it's highly scalable. Now Patria is following the same business model. It's following the footsteps of Blackstone. It acquired in the second quarter another 50% stake in VIB Real Estate, which is the leading REIT asset manager in Blackstone, so that's good news as well. And the third piece of good news is that the company announced a new buyback plan, and here's what the CEO said about it. Of note, we are excited to announce an important update to our capital management strategy and our intention to repurchase up to 1.8 million shares over the next 12 months as we look to maximize returns to shareholders. Overall, I'm very confident that we will reach our 2024 target for fee-related income of at least $170 million, on the way to generating 200 to 225 million of fee-related income in 2025. That's all great news in my opinion, and the share buyback, while not very big in size, it still sends a strong signal to the market that the management is willing to take action if the share price doesn't reflect the fair value of the company. But despite that, the share price of the company declined, and I think that this is likely because of its dividend announcement. The headlines on Yahoo Finance, Seeking Alpha and elsewhere show that the company reduced its dividend, which leads people to think that the company is struggling. But that's not really the case. As I just explained, the company is actually doing better than ever and even increasing its guidance, so it's performing better than what most people would have expected. But the dividend reduction is simply the result of the company's variable dividend policy. This is nothing new, but if you read the comments on YouTube or on Seeking Alpha, it sure seems that most investors still haven't understood what this variable dividend policy really means. What's happening here is simply that the company is prioritizing debt paydowns and buybacks in the near term, and therefore it wants to retain more of its cash flow in-house to take care of those two things rather than paying a high dividend. However, the company is expected to be debt-free by the end of this year already or in early 2025, and the company told us recently in an email exchange that they will share more about their dividend towards the end of the year. Our expectation is that once the company is done paying down its debt, it's going to switch back to returning more cash to its shareholders already in 2025, so in less than a year from now, and this is going to take place via dividends and buybacks, and I'm all for it. The company share price is very heavily discounted, and I think that buybacks can help it reach its fair value, which ultimately, in our opinion, is about 100% higher from here. While you wait, even with this lower dividend payout, you're still earning a roughly 5% dividend yield, and that's likely to be a lot higher in 2025 and 2026 as the company keeps on growing. Hey, before I go into the second company, can you please do me a huge favor and click the like button if you think that this content is valuable? It will help me a lot to keep on growing. Thank you so much in advance. And then the second company that I want to discuss here is called Alexandria Real Estate, ticker symbol ARE. This is one of my biggest REIT investments. I've discussed it quite often on this channel. It's a REIT that specializes in life science buildings, which are highly specialized buildings that biotech and pharma companies use to conduct their research and development. This is a sector that enjoys strong long-term tailwinds as more and more money is pumped into research to develop new drugs, and Alexandria's infrastructure is essential to it because you cannot do this work from home. You need a lab with highly specialized equipment, security protocols, and so on, and Alexandria is here to provide that. The company posted second quarter results on the 22nd of July, and its share price has dipped by about 10% since then. This is especially interesting because many other REITs of similar quality like Camden Property Trust, Mid-America Apartment Communities surged during the same time period, even as Alexandria dropped in value. So what went wrong here? And if you just look at its results very quickly, it's hard to see because the company actually beat its quarterly expectations for FFO. It maintained its full year guidance. However, what the market didn't seem to like was the management's commentary on the conference call, which seemed to imply that its growth would potentially slow down for a year or two. Here's what they said. I would say the market moved from a historical long bull run to a bear market, and what he's referring to here is the oversupply that this sector is currently dealing with. Following the pandemic, there was a surge in demand for life science space, and this attracted a lot of capital and real estate developers who started building new properties, especially since interest rates were very low, financing was easily available, and a lot of this supply is now hitting the market, and it's putting some pressure on Alexandria, and it could lead to a slight dip in its occupancy rate in the near term. It's likely going to complicate leasing and maybe slow down the rent growth. However, I don't think that this is such a big deal as the market make it seem to be. Even despite these headwinds, the company was still able to grow its same property NOI by 4% in the last quarter, and its occupancy rate remained stable at around 95%. That's largely because Alexandria is well protected with its long-term leases, which have over 6 years left on them on average, and also include 3% average annual rent escalators. Moreover, most of Alexandria's leases are today deeply below market because in the post-COVID boom period, market rents grew even faster than the lease escalators in Alexandria's leases, and as a result, its rent fell deeply below market, and today, as its leases gradually expire, it's able to bump up its rents quite significantly. So far in 2024, it's been able to hike its rent on average by 15% on new leases. That's down from what its rent hikes were a few years ago, even last year, and the market doesn't like that. But again, it shows that we are not going through a nightmare scenario here. And it's very important to put this in the context of the company's valuation today. Right now, it's priced at 12 times FFO, which is a historically low valuation multiple for the company. In fact, it's really close to the lowest valuation in a very long time, because historically the company has commonly traded at closer to double of that, at 20, 25, or even 30 times FFO at close to its peak, because Alexandria is really a fortress of a REIT when you think about it. It operates in a property sector that's recession resistant, which has very very strong long-term tailwinds with growing demand. It's the leader in this space. It requires unique skills and it has strong competitive advantages in its expertise, but also relationships with tenants. The company has an amazing balance sheet, really one of the strongest in the entire REIT sector, with a BBB+ credit rating, 13-year long average debt maturities, that's some of the longest in the entire REIT sector, just a 25% LTV, billions of liquidity available to take on new projects. It has an amazing track record also at developing and redeveloping new properties at cap rate, initial yields much higher than the cap rate in this property segment, so creating a lot of shareholder value. And if you put all of this together and you look at the track record of the company, it's amazing. It has even managed to outperform companies like Walmart and Warren Buffett's Berkshire Hathaway over the long run. And so understandably, the REIT market has historically rewarded Alexandria with a very high valuation multiple during most times, but this isn't the case today because the market is only focused on the next quarter, the next year, and it's true that it's going to be quite a bit worse than the usual performance of Alexandria because we're dealing with oversupply. But if you can now look a few years out, I think that this is a great opportunity because times of oversupply are typically followed by times of undersupply, because now developers are getting burned, they are not able to lease their properties, they are suffering losses as cap rates expanded, and interest rates also have surged a lot, so this has put most new construction projects on halt. And because of this, now Alexandria expect 2024 to be peak supply, but already in 2025 we should see the supply come down very significantly, and even more so in 2026, and this positions Alexandria for strong acceleration in its rent growth in the coming years. As its rent growth accelerates, even as interest rates come down around the same time, I expect a lot of investors to suddenly see a lot more value in Alexandria, bid up in share price, leading to FFO multiple expansion. I really wouldn't be surprised if it returns to at least 18 times, and that will result in about 50% upside from here. While you wait, you're earning a nearly 5% dividend yield, which may not seem particularly high, but you need to keep in mind here that the payout ratio is very low for this REIT, and they have a strong track record of dividend growth, and I expect this to continue going forward. That's a very attractive risk to reward proposition in my opinion, coming from such a defensive REIT like Alexandria. For these reasons, I'm planning to buy the dip in Alexandria. I've also bought the dip already for Patria, but also for many other companies. If you want to access my entire real money portfolio and all my trade alerts in real time, along with the research that comes with it, you can join High Yield Landlord, which is my REIT newsletter, for a 2-week free trial. I'll put a link to it in the description of this video. Otherwise, once more, if you thought that this was interesting, it will really help me if you click the like button. Also subscribe to the channel because I will post some of these interviews also here. Thank you so much in advance. See you at my next one. Bye bye.